Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Seema Mody in for Bob Pisani, and I'm joined today by Dave Nadig of ETF.com and Steve Grasso of Stuart Frankel. Good to see you both. Stocks broadly higher after starting September with a sell-off, easing tensions between Hong Kong protesters and the government, giving U.S. stocks a lift, but that's not stopping investors from seeking safety in one of the most historically volatile months of the year. Now, ETFs tracking gold, bonds, and consumer staples all seeing major inflows in the last month, while market stalwarts like the SPY S&P 500 ETF continue to get crushed. So, should investors stick with the safety trade through September? And Dave, you're looking at this.
Yeah, so a lot of people are looking at those consumer staple stocks. We've been talking about them making all-time highs. I get nervous about leaning hard into consumer staples because the definition isn't what we think it is. It's tobacco, it's retail. I think people should be looking at other ways to play defense.
Others would disagree. They say this is a good, stable sector to own amidst this broader volatility in the market. Steve?
Right. So the problem is that there's been nothing logical about this marketplace. So this gentleman's answer was extremely logical, makes a ton of sense for every other market that we've seen. And I think we're seeing something totally different. I know I always get nervous when people say it's different this time, but I think you have to look at those safety bets extending their gains and their outperformance longer than they have traditionally, and that's why I would still stay in.
And the market seems to like this sector. I mean, there were only 3 sectors that posted gains in the month of October: utilities, real estate, and consumer staples.
Yep, I understand, and I think it's fair to look at your equity portfolio and try to find a way to play defense. I just think the traditional sector approach here is misguided. I would be looking for stocks that exhibit low beta to the market, or that you know historically are going to perform reasonably well in a downturn. There are funds that do that. The Invesco Defensive Equity ETF, DEF, is one way to play that. It's done quite well over the last year, while the S&P is up a couple percent.
Steve, what about the valuation concern when looking at consumer staples?
So I wouldn't, if you overlay historic valuation issues or historic values, then you're going to have a problem buying them. You're going to have to hold your nose and buy them. But I would say that you could pass through and just go to utilities, which are overvalued as well, but they continue to outperform. If you want to talk valuation, how do you figure out valuation on something like gold or GDX, that the miners? So
basic fundamentals, you just can't apply them to the market right now, at least some of these sectors.
You know, unfortunately and fortunately, as a trader, you get to throw out fundamentals when you want, when they work, when they set to your narration. But for me, the story is go with what's working, because nothing has changed. I don't have any edge on Brexit. I don't have any edge on China trade. And I don't have any edge on the Fed right now. So I have to go with what has performed. And those are the safety bets. And gold. I think you have to stay in gold as well.
And we can't overlook the move that we're seeing in the bond market and how that plays into these specific sectors outperforming. There are now actually, I should say, 60% of stocks in the S&P 500 that have a dividend yield that is higher than the yield on the 10-year. That's certainly helping consumer staples.
Absolutely, and we've seen huge outflows in things like corporate bonds. Investors are not looking there for their yield plays anymore. I think utilities, if you're looking for yield, continues to be a great way to do that. I think high yield stocks in general are probably a good place to be if we see a sustained downturn.
But over time, investors get a bit more selective, I assume, right?
Over time, they get selective, and I think what's a good homework piece for investors is to look at the ETF's performance on a 5-year basis, on a 3-year basis, and then look year to date. And then if you really want to get granular about it, look for something in the 1-month range and 3-month range. Consistent outperformance?
Sure.
Stay with it.
Yep.
So don't make it overly complicated, but you do want to look backdated on a lot of these things. Obviously, technology space has outperformed for the last 5 years. It's such a big portion of the S&P. It can't help but outperform and underperform in good times and in bad
times. Although it just lost its lead to real estate, which is now the top performing sector for this year.
Right.
I mean, that's kind of a big deal, right?
It is a big deal, but I think investors should be really careful about trying to chase these things. One thing I think we could probably all agree with, the wrong thing to do as we start seeing some of this negative economic data is to pull the ripcord and say, I'm just going into cash. Investors are terrible at making those kinds of timing decisions. I would argue chasing something like real estate because it's had a good quarter, also a terrible timing decision for most investors.
Think about the beauty of ETFs. You don't have to worry about an explosion in one name, a blow up in one name. So that's the beauty of being able to invest in ETFs for the longer term. And you could rotate in and out quarter by quarter, year by year. but you get the chance to stay invested instead of worrying about single stock analysis.
That makes sense. Now, with volatility gripping the stock market, let's talk about playing defense. Dave, you have an ETF you're looking at that can offer some protection. What is it?
Sure, and I put this name up earlier. This is the Invesco Defensive Equity ETF, DEF. It looks for safety plays, but with, I think, a more modern approach. So it looks for stocks that have really high betas. It kicks those out of the S&P 500. It looks for stocks that have historically done poorly in downturns. It kicks those out of the S&P 500. Then it looks at what's left and it only picks those with really long-term sustainable revenue models. You end up with 100 equal weighted stocks with pretty broad sector exposure. I think it's a great play for a lot of investors who want to stay invested in the equity market.
Yeah, not what I would expect. We have Amgen, we have Hershey's. I mean, what do you think of this trade?
So it depends on how you want to define safety, but I think for all apparent purposes, this is an excellent way to do so because you have things that are clearly defined as safety, clearly defined as risk, and I think you sort of get a hybrid model here where you only go with things that have outperformed.
Yeah, and I think it avoids the trap of saying, I'm not going to own any technology because that's growth and we're not going to be in a growth market, or I'm going to avoid all healthcare stocks because that's a political football. I think it lets you stay invested, and I think that's the most important thing as we head into what's going to be in a crazy 18 months.
And think about every other ETF. It's just specific to one sector in one space.
Right.
So you're going to start seeing a lot more of these hybrid models coming along. And I think they're a great choice for people preparing for their own retirement or their children's investment.
Redefining the definition of playing defense, right?
Exactly.
I mean, it makes sense, I guess, in this type of environment.
Exactly.
Okay. All right. Now, Steve, how would you recommend investors defend their holdings here?
So you have to look at, I do it on a quarterly basis. So I look at what has outperformed and then I rotate into the underperformers. But in this case, you really have to be a little strange about your investment thesis because a lot of the things that should not continue to outperform, continue to outperform. So I like buying winners. I like selling losers. Or I like, at the very least, not increasing my holdings in what has been underperforming. Go with what has outperformed, stay in those trades.
What do you make of energy, which actually has been such an underperformer? It's up today, but worst performing sector in August, worst performer for the year. At some point, does this sector look attractive?
On a day-by-day basis, but you have to pull the ripcord, to use your analogy, extremely quickly. But in energy, we are oversupplied in the energy markets. Could you have ever scripted a more bullish scenario or backdrop for energy?
And it's only getting worse, honestly. If we do think there's any kind of global slowdown here, that's negative for energy. So we're going to be oversupplied, we're going to be under-demanded. That's usually a recipe for prices coming down. It's really tough to look at the energy sector.
So your
and find
assessment
much
is
to
that
love.
the pain continues, especially for some of these oil-related ETFs?
Unless we have a huge upside surprise in economic activity, frankly, across the globe, and I just don't see that.
Got it. All right, well, let's end by looking at a red-hot trend this year, and that's IPOs. Check out Renaissance Capital's IPO ETF, up 32% this year, almost double the gains of the S&P 500. This as Wall Street obsesses over WeWork's debut as heavy hitters Uber and Lyft sink to all-time lows. With more high-profile IPOs straight ahead, let's check in with Kathleen Smith, chairman and co-founder of Renaissance Capital, for her expertise, joining us on the desk. Kathy, it's great to see you. We know the ETF. Help remind our audience what your ETF sort of encompasses.
It's a basket of a 2-year rolling population of newly public companies, and it's weighted by market cap, so it owns the largest, most liquid IPOs that have been done over the last 2 years. It has a quarterly rebalance, but also a fast entry if there's a very large IPO. So it's the only ETF in the marketplace that has pure exposure to newly public companies.
Now we have Smile Direct Club, Peloton, WeWork, all on deck in the next couple of weeks. How are you kind of looking at these new names coming to market?
Well, the ETF will include the larger, more liquid names, those you've mentioned, and we're looking at it from a buy side. So we're hoping that the valuations are much more reasonable than the way they valued Uber and Lyft. And I think Uber and Lyft's poor trading is going to be a big advantage to the buy-side investors when we address WeWork, Smile Direct. All of these companies are going to have to please a pretty nervous set of investors who already got burnt in some of these large money-losing IPOs.
Well, because importantly, you guys are buying these IPOs after they're publicly traded. You're not getting big allocations because you're a friend or a family member. And that means you want them to be priced, at least accurately and maybe a little low for their actual opportunities, and that's what generates the performance your fund's so well known for.
Well, and we do, and so the beauty is that even though Uber became a top 10 holding in our product, we've had some very strong names. I mean, Roku is the second largest holding in our product right now. And it's interesting to see how it works because on Roku, it's a 7% holding in the ETF, and I looked at all other ETFs and who has the largest holding. It's our IPO ETF, the second largest holding is less than 2% of another ETF in the market. So we are getting exposure for investors to these very new names that are not included in other or underweighted in many other indices.
I'd like to get your perspective on WeWork because it has garnered a lot of criticism and it hasn't even gone public yet. It's raised $12 billion since it launched, but has yet to turn a profit. What do you make of the name?
Well, it's hard not to think about Uber when you think about WeWork. We've studied IPOs all through history, and the most money-losing IPO ever in the 12 months leading to its IPO was Uber. The second one is WeWork. The third one is Lyft. If you look at the performance of those IPOs, they do not do well for investors. It's going to be incumbent upon WeWork, and for many reasons, to get that valuation low. On valuation, for example, there's a perfect peer trading in the market. And if you valued WeWork like that peer, instead of being its $47 billion private valuation, it'd have a $20 billion valuation. So we'll see how this goes. I think it's important. An interesting, disruptive company, but it has to be valued correctly.
So they may be loss-making, Steve, but is it still a good sign that more companies are going public amidst this broader volatility in the market?
I've been in the market since 1993, and I've heard that be a great sign, and I've heard everyone say it's the top of the market. So it depends on which glass you're looking through. But when you see the majority of these IPOs are well-priced and perform well after the fact, you do get a little push and pull. So hopefully the minority of them have an issue in 30 days, 60 days, 90 days out. Obviously the lockups, when you play individual names, always know when the lockup expires.
Sure.
That's the death nail to a lot of these companies short term.
Could see increased selling around
Correct.
those times. Kathleen, finally, we hear a lot of people compare this market to a dot-com bubble, loss-making companies tied to excessive valuations. I mean, do you see truth to that analogy?
There's a little bit of a rhyme to the internet bubble, but not even close on a few metrics. I think probably the most important one is if you look at the average age of an IPO coming out now, it's about 10 years. Back in the 99-2000, we saw companies that weren't even a year old. The excess was incredible. The numbers, the dollar volume, it was 2 to 3 times anything we're seeing now. So, and the retail investor was in the market big time in 99-2000. Now, individual investors and their advisors, they own ETFs. There is not a big retail component in the IPO market, meaning it's slightly more disciplined than it was back then when individual investors just we'd be at a cocktail party, and I was a popular person back then. Now, there's many other subjects, but it isn't about individual stocks. I'm sure you've all seen it.
Impressive to see that your ETF is up 32% because we tend to fixate on Uber and Lyft at all-time lows, but there's some names that have actually done pretty well.
It's absolutely been on fire. It's been a phenomenal market to be part of. I actually think this is a very healthy IPO market. You're always going to have a couple that come to market that are really overvalued. It really does come to that consistent, accurate valuations. You want IPOs to come out and move 1% or 2% on the day they come out. We've seen some of those, and then people learn those stocks. They run up, they show up in Kathleen's fund, and you get that kind of performance.
And then you look at Beyond Meat, best performing IPO this year. I mean, out of the park.
Yeah, it's crazy when you look at Beyond Meat, and you taste the product, it's a great product, but there's a social aspect that is 90% of the performance on Beyond Meat. And when you look at a company like Tyson that didn't perform well as of late, there's a lot of competition that could come on. So you have to be careful when you see these outsized gains and how long individual names can really extend those gains. And that's why it's always a safer bet to go into an exchange-traded fund where you have a little bit of the muting of the risk analysis.
Well, it's certainly an interesting part of the market. Kathleen, thanks for providing your perspective here. That's going to do for us on ETF Edge. I'm Seema Mody. Thank you to Kathleen, Dave, and Steve for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We will see you next time. Have a great week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.